Hello, this is Brian Rezny, president of Rezny Wealth Management, and of course the host of the Rezny Wealth Report TV show, live every Wednesday night at 6 p.m. By the way, if you miss any part of today's program or you'd like to re-watch today's program, we do play on Sunday nights at 7:30, a repeat of today's program. We are going to be taking live calls in today. If you have a question about a stock or a bond, maybe you own a mutual fund, or maybe you're questioning the advice you're receiving. Maybe somebody sold you 3 or 4 annuities and you're realizing that's not good for your retirement portfolio. Call me in the studio. I will give you a direct, straightforward answer that you can understand for any of your investment questions or retirement needs. Our studio line is open right now. When you call that number, I'll either take your call live on air, or if you'd rather, you can give your question to one of my studio producers, and I'll take your question off air if that's a little easier. You can also visit my website, reznywealth.com. Send me an email question that I will also read and answer on the program. Again, our website is reznywealth.com, and I'm going to put that number up again on the screen so you can make sure you do call with your questions. We love getting calls. We love getting questions. This show is all about you, the investor, so we can help you do better in your retirement and avoid the pitfalls and the mistakes that so many retirees make by getting bad investment advice. One of the things that I want to talk a little bit about today, first off, is we're seeing an improvement in the U.S. economy. We're seeing some improvements in the emerging market economies. Of course, Europe still seems to be falling apart, to put it bluntly, but we had a major rally today, of course, in the U.S. equity markets. There's all kinds of noise out there. All this noise, it basically scares investors to make the wrong decisions at exactly the wrong time. I want to discuss a little bit why you need an investment strategy and why you need to get rid of the noise and a lot of these programs that hype different things in the economy, like the fiscal cliff, question, all these problems that focus in on you, the investor, that ultimately creates emotion and bad decisions. The number one problem investors face today is they don't follow an investment strategy. I'm going to bring up a quick little picture here. If you want to be successful with investing, it's like baking a cake. If you want to bake a cake, you have to start with a recipe card, you have to start with the right ingredients, and you got to cook it the right amount of time. Investing's no different. You need to have an investment strategy, you need to put the right investments inside of that investment strategy, and you need to manage risk. I think too many investors today are shooting from the hip. What I mean by that is simple. You talk to so-called advisor, Mr. Broker from a Wall Street firm, and basically you sit down with that person and he sells you 5 or 10 mutual funds or 20 stocks or some bonds or maybe an annuity. That's not an investment strategy, folks. An investment strategy has to be laid out and back tested to make sure that strategy actually works. So at least it gives you an indication based upon a parameter, has that strategy worked in the past? It's not a guarantee that it'll work in the future to the same extent, but at least it's a groundwork or foundation. Too many investors that come into our offices every week, the first question we usually ask is, do you have a copy of the investment strategy you're following? And most of these people look at me like, investment strategy in writing, we don't have one. And that is usually the crux of the problem, is by not following a strategy is like trying to bake a cake in the kitchen without following a recipe card. I'm taking your calls, by the way, today. So if you have a question about any investment, whether it's about a stock, bond, a mutual fund, again, maybe somebody sold you a whole bunch of annuities and you're realizing that's not the best thing for your retirement, call me in the studio right now, 239-417-4711. We're taking your calls live, or you can call that same number and give your question to a studio producer, and I'll take your question off air. I want to go to my first question. Tom from Fort Myers basically calls in, what are my thoughts about variable annuities? I was sold 4 annuities over the last 7 years. None have done well. Can I get out? Tom, let me tell you what, your problem with variable annuities is like half of the people that we talk to in our offices every week. Annuities are one of the number one sold investments, in our opinion, for one reason. It lines the broker or that so-called advisor's pocket the most. Variable annuities are probably one of the worst investments ever manufactured by insurance companies and Wall Street. These things are ladled with high expenses and often mediocre investments. Once you pick those mediocre investments, who's actually watching them after you bought them? Certainly not the broker or that so-called advisor. The problem that you have, Tom, is you obviously have a broker or a wolf in sheep's clothing selling you what's lining his pocket or her pocket the most. I always warn investors, annuities are sold products. There are very few people or instances that I've seen in 27 years in the money management business that an annuity or a variable annuity is appropriate. What you could do, Tom, is you can get rid of these annuities if you're past surrender. If you're not past surrender, Tom, you can still get rid of them. What you want to do is take a look at what is the annual average cost of the annuity you have minus the expense ratio. What you want to do is you want to see how many more years you have to get out of this annuity before surrender. If you can get out of an annuity now, and let's say pay a 3% penalty, but you can get rid of a 4% annual internal cost structure. By the way, folks, the average annuity that we have reviewed in our office carries an expense ratio often between 3 to 5% annual internal cost structure. So if you're getting rid of a 4% expense and you can get into real quality investments with a lower cost of, let's say, 1.5%, it might make sense to get rid of that variable annuity earlier to get rid of the cost, because you may make up that penalty by reduced cost much sooner. That's a simplified version, but again, most annuities have very high expenses. When you pull the money out, if you did make money, you're normally taxed at ordinary income rates, which are double for many people than capital gain rates, and you have mediocre investments with no investment strategy. Tom, that sounds like a recipe for disaster. What I would recommend, if you'd like, you can always call our office, make an appointment with our Fort Myers office or our Naples office. We can sit down with you and we can assess these annuities to really help you make a better decision. Should these things be thrown in the garbage, or do they actually have value? I would probably tell you many of them are going to be ready to be tossed in the garbage because you're probably much better off doing something else. If you have a question about your portfolio, again, in the studio like Tom just called, 239-417-4711. I want to go to my next call. Ralph in Punta Gorda. Brian, what do you think of the PIMCO Total Return Fund? I have half of my $1.2 million portfolio in it. Ralph, great question. The PIMCO Total Return Fund, Bill Gross runs this fund. It's actually one of the biggest bond mutual funds in the world. Mr. Gross has done an excellent job, by the way, managing this portfolio over the long term. The problem I have today is this. Number one, I would not have half of your money in that fund. In fact, even though I like the manager and I like the fund in the past, I think the fund is far too big and not nimble enough in today's environment. I would actually looking at alternative either ETFs or maybe other no-load mutual funds that may give you income opportunities but are not as big as that PIMCO Total Return Fund. I don't think the fund is nimble enough in today's economy. Interest rates are too low, and I think ultimately you're probably not going to see near the performance out of this fund that you saw the last 2, 3, or 4 years. In fact, I would anticipate it'll be a lot less. It's a fund that the manager's great, the fund's done well, but those are the past. You need to look in the future. If it was me, I would get a second opinion and look at 3 or 4 different funds to replace that one PIMCO fund with. Folks, I have to take a short break. I'm going to be right back with your calls and your questions. Call me right now at 239-417-4711. This is Brian Rezny. I'll be right back with more questions after this short break. Hi, I'm Brian Rezny. If you're like many investors, you've lost a lot of your retirement assets due to poor investment management or being sold investments that are often better for that so-called advisor than you. Most so-called advisors are just salespeople or brokers for investments their firms represent. No real advice at all. If you're tired of bad investment advice and are ready for positive change for your retirement, call my firm for a consultation. Don't settle for bad investment advice. There is a difference. Call us today. Hello, we're back. I'm Brian Rezny, the host of the Rezny Wealth Report. Again, we're here live every Wednesday at 6 p.m., and we do rebroadcast our program, so if you miss any part of this Sunday night at 7:30. I would also encourage you to visit my website, ReznyWealth.com. You can sign up for our newsletter. It comes out every Monday. That is free. We also have ongoing educational investment and retirement workshops, not free seminars where you're going to be pitched an annuity or some product to buy. These are hard-hitting, tell-all workshops that really help retirees adapt and prosper in any economy. In fact, we call our workshop Adapt or Fail. If you're a retiree and you want to find out more about my workshops and to sign up, you can visit my website, ReznyWealth.com. You can also call right now at 239-417-4711 if you do have a question about your portfolio. I want to go to my next question. Mike from Fort Myers. What do I think about equity index annuities? I went to a free lunch seminar. Mike, great question. Free lunch seminars and annuities always seem to go hand in hand. Remember, the person selling an annuity is not an advisor at all. They're an annuity salesperson, and their interests, Mike, are going to be far different than yours. There is no free lunch. You need to get an education. Anytime you go to a free lunch seminar, the bottom line is you're usually going to be sold something. Unfortunately, it seems to be about 90% of the time it's somebody trying to hawk some kind of an annuity. Equity index annuities are different than variable annuities. In fact, I even think they're worse than variable annuities. There's been a lot of writings and white papers about equity index annuities and the hazards against retirees. I can tell you the number one question that I receive on my live radio show on Sundays is about equity index annuities and free lunch seminars. I could do every Sunday show about these, but of course we limit how many questions on each topic we're going to take. Otherwise, people would be bored just talking about these products. Equity index annuities have some of the longest, highest surrender penalties of any annuity product. These things are highly complex, they are internally expensive, and your investment is not going to be served or your best interest. FINRA, which governs the brokerage firms, and the SEC have put out massive warnings about equity annuities and misleading sales and free lunch seminars to seniors. Stay away from these products at all costs. They're not going to give you free money like that guy's claiming. You're not going to get a free money bonus, and you're not going to make 8% on your money. That's hocus pocus, fake money. You really need to find out more facts. Ask for a specimen policy. Take that home and read it. What I'm going to probably tell you is going to scare you. Mr. Insurance Salesman won't give you the specimen policy, even though by law he has to, if you ask for it. If you read it, it's about this thick, it's highly complex, it'll confuse the heck out of you, and hopefully that'll scare you enough not to buy one of these products. That's a great sale for Mr. Insurance Salesman, but it's a lousy investment for your retirement account. I want to go to my next caller. Thomas in Marco Island. Apple Computer, symbol AAPL. What do I think? I get a lot of questions in the last 12 months on Apple Computer because it ran up a lot, and in the last 4 months, it's run down a lot. Let me tell you what. If you're looking at any individual stock, you need to do hardcore research. Don't buy a stock just because you heard of the company or you think you know something about the company. You need to have an investment strategy, and how does that stock, based upon hard research, not looking at the daily price going up or down, but real research, under the hood type stuff. What I warned investors about, this is over 4 months ago, Apple was a sell. Apple is down almost 40% from when we told investors they need to take a second look at Apple and look at selling. I would tell you to take a look at the 50-day moving average, the 100-day moving average, Thomas, and the 200-day moving average. The 50-day is a short-term indicator of maybe there's problems. Apple crossed that over 3 months ago. The 100-day is watch out below, and if it crosses the 200, which it did a long time ago, well over 6 weeks ago, I believe, that tells you get out of the way. Apple is a decisive sell. I ultimately believe Apple will go lower. I think it's a great company, but the heydays of their high-quality products, and of course Steve Jobs unfortunately is no longer here, I think that's a stock that needs to be sold. I would not touch it with a 10-foot pole, and I warned investors about this over 4 months ago. I want to go to a quick graph with that. Take a look at this graph on Apple, by the way. This shows you, again, those moving averages I talked about, and if you look on your far right, you can clearly see how the hill has fallen off a cliff, basically, and how Apple has gone under its 50, 100, and its 200, 100-day moving average. I believe graphs, Thomas, really help you, the investor. Anytime you own a stock or you're thinking about buying a stock, pull up a picture, pull up a graph. If the stock's not trending up or relatively strong, don't touch it. Never ever buy a stock on its way down, and never add to a stock that's on its way down. Relative weakness usually underperforms, and relative strength up outperforms. You are much better statistically to buy a stock hitting 52-week highs than 52-week lows. In fact, I'm going to write about that in my newsletter this week coming up. So go to my website, thomasreznywealth.com. You can sign up for my newsletter. It is free. And at the same time, you can also schedule a consultation to meet us at one of our offices, either Fort Myers or Naples. I want to go to another quick question. Edward from Naples, I have an account with UBS. I heard they were fined $1.5 billion because of the LIBOR scandal. Should I be concerned? Why? Yes, you should be concerned. Now, UBS is a bank, and UBS, the security part where you have an account with, or the bank, either one, these are wholly owned subsidiaries of each other. You should be concerned. Think about this. UBS, the bank, was fixing LIBOR rates for years and years and years. They cheated investors. They cheated. The bottom line is, if they got a $1.5 billion fine, why would you want to leave your money there? You should go to finra.org or sec.gov. You can type in UBS in the news search, find out if they've ever been fined before on other things. I believe how a firm conducts itself should speak volumes to you, the investor. No investor, in my personal opinion, should ever have an account at a firm that's been fined $1.5 billion. How do you know that they're not doing other things that are going to affect you, the client? Think about that. If you want to check out your brokerage firm, go to FINRA, F-I-N-R-A, FINRA.org. Type in that broker-dealer name, that brokerage firm name. Find out if they've been fined or censured. Or go to sec.gov. Do yourself a favor. Research the company you're doing business with. UBS, by the way, wasn't the only company being fined. A lot of these firms were fined. Find out the facts and make sure you understand who you're entrusting your hard-earned dollars to. Want to go to another quick question. Jim in Fort Myers. I'm currently working with a fee-based advisor. Can you explain the difference between fee-only and fee-based? Are we taking new clients? Jim, we are taking new clients. I want to answer that question first. We always like taking on new clients who are nice people to do business with. That is number one. Number two, we do have a criteria for our account minimum size. So what I would suggest is call our office tomorrow and schedule a consultation at one of our offices, and you could talk to one of my staff members. We're going to put that number up on the bottom of the screen. For the second part of your question, fee-based means a company who basically charges fees and earns commission. Typically, broker-dealers, brokerage firms are a commission-based house. They also offer investment advisory services on a fee basis. So they have commission-based and they got fees. That's fee-based. The problem with a fee-based advisor, they often have all of the conflicts of interest as the broker-dealer firm does. Because since they're typically one and the same, they can cross-sell products, and the fee-side advisory side can also use products that might be proprietary or manufactured by that brokerage firm. Again, as long as they disclose it and you accept it, fine. But fee-only is much different than fee-based. When you're in a fee-only arrangement like a firm like ours, we don't work for Wall Street or some bank. We are 100% work for our client in a fiduciary capacity. Since we don't manufacture investments, we don't work with Wall Street shenanigans, we don't sell anything but investment management. And all the investments a firm that's in a fee-only capacity would utilize should be and always will be in the best interest of the client. So there's no conflicts of interest like a fee-based or a commission-based firm would be. So fee-only, bar none, is the way you want to go. So if you're looking for a firm, always look for fee-only. Fee-based is still going to have a lot of the conflicts of interest associated with Wall Street. By the way, if you want to know if you're working with a fee-only firm or you're in the interview process, we've got a great tool on our website. Go to my website, reznywealth.com. On the right side of the homepage, for free, you can download the fiduciary Registered Investment Advisor Questionnaire. It is a must-use tool if you're questioning the advice you're getting, and you'll learn about fee-only and fee-based, by the way, or if you're interviewing somebody as a new advisor. I've got to take a short break. I'm going to come back with more of your calls and questions after this. Hello, I'm Brian Rezny, president of Rezny Wealth Management. Do you know the biggest risk to your retirement and investments? One is entrusting your hard-earned money to someone who doesn't work in your best interest. The other is a lack of a detailed investment strategy to meet your goals. Both risks can be devastating, but both can be corrected. Rezny Wealth Management, fee-only money management. Don't settle for questionable investment advice. Call my firm for a consultation. There is a difference. And we're back. I'm Brian Rezny, the host of the Rezny Wealth Report. I hope you're enjoying today's program. We're getting a lot of off-air questions. Again, folks, you can call with your questions. I'll take them off-air or I'll take them live, whatever is more comfortable. And I know sometimes people think when you're calling on the program, you don't want to hear your voice on TV. That's fine. Believe me, it's no different than calling the grandkids on the cell phone or the kids. But if you want to call with a question, I'll take you live or off air like we've been doing tonight. 239, bottom of the screen, 417-4711. I know I have at least one more question that came off air. We'll go to that in just a little bit. I want to talk a little bit more about this economy, though. And I want to talk about what scares too many investors. It's called hype. Too many of a lot of these news programs talk about the same thing over and over and over again. Okay? We call it, in the real business, the talking heads. They don't give you any real concrete information. It's always talking about the world's coming to an end, the fiscal cliff's falling off, things that are going to scare you, the investor. The bottom line, folks, that's all hocus pocus. News and noise isn't going to help you at all in your retirement or picking your investments. Real research is going to help you that isn't tainted by Wall Street conflicts of interest, and a real investment strategy. I cannot stress how important it is to follow a detailed investment strategy to achieve your investment results. By the way, your investment strategy can be highly complex. If you've done a lot of research, it can be a little bit more simplified. But at the end of the day, an investment strategy needs to be in writing, and it needs to be followed like a recipe card. If you don't have an investment strategy, folks, and be honest with yourself, can you right now reach over to your file cabinet and pull out an investment strategy that you or your advisor is following? If you can't, your money's not being managed at all, and what you're basically doing is collecting investments like you have bikes and lawnmowers and all kinds of tools in your garage. Some are useful, some are not, but they don't work together. That's why you need a strategy. I want to go to my next call, by the way. This is Susan in Marco Island, Florida. I own Microsoft and Intel. What do you think of these stocks? Susan, great question. I get a lot of calls about Microsoft and Intel, and the reason I typically get calls on large cap, big name companies is because people tend to buy what they're familiar with. And again, it doesn't necessarily mean you've done a lot of groundwork or research. It means, hey, I've heard of Apple, I heard of Microsoft, I heard of Intel, I heard of ExxonMobil. People buy what they're familiar with. That doesn't make them good investments. In fact, let me tell you statistically, Intel and Microsoft are great companies. They're not great investments, okay? The growth days of either one of these two companies is gone. They're going to do acquisitions over time. They'll have some new products, and their growth will kind of stay there, and it won't be very big, in my personal opinion, and from our real-time research. If you take a look at Microsoft and Intel both, and you would have just bought the S&P 500, the broad index, the basket of 500 large-cap stocks, you would have actually done better over the last 10 years than owning Microsoft or Intel. So the bottom line is there's a time in life where every investment has its time to sell. You want to know when to buy, but more importantly, part of that investment strategy that I talked about earlier, you need to know when to sell, when to let go. The problem that a lot of people face is when they own stocks like Microsoft and Intel, they may have bought them in 2000 at the top and they wrote them down and they're waiting or hoping they go back up. Or maybe they look at them that, hey, it used to be $60 a share. Now it's $25. That's cheap? Not necessarily. any stock that's high and comes down, it doesn't necessarily guarantee it's going to go back in value, Susan. So what I would tell you with both Microsoft and Intel, I'm not a fan of the investment. If I owned them, if I was you and I owned them, I would look elsewhere for better opportunity. I'll give you two ideas that I like right now that I think far and exceed and have less risk than Microsoft or Intel. One is the Wisdom Tree Small Cap Dividend Paying ETF. It's emerging markets, small cap emerging markets, symbol DGS. This owns a broad basket of about 400 or 500 small cap emerging market stocks. Great dividend, great growth potential because of the emerging markets. Another one is the iShares Midcap 400, symbol IJH. This is the smaller companies, not the big 500 large companies in the S&P, but the smaller grouping of 400 midcap. Fair disclosure, we own both of these and have for a while. I like both of these better than Microsoft and Intel. You'd have better diversification. I think you'd have a much better chance for upside potential. And generally speaking, the dividend is going to be about the same or better between the two of these. So I think those would be better opportunities for your money. Again, I don't know all your personal risk preference and your goals and objectives, but Intel or Microsoft or DGS and IJH, I'd go with the DGS and the IJH. I think you have a much better opportunity for your portfolio over the next 1, 3, and 5 years. Folks, we are just about out of time. I can't take any more calls today. I do want to focus you to go to my website, ReznyWealth.com. That's ReznyWealth.com. For free, you can sign up for our weekly newsletter. It comes out Monday. It's full of good information about investing. And more importantly, we teach you not to make bad investment mistakes, not to be sold the next annuity at the free lunch seminar, where to look for income opportunities, how to protect and grow your portfolio. That's what our newsletter is all about, and it's free. Go to my website right now, ReznyWealth.com. And we also have some upcoming workshops. You can check those out. If you want to sign up, that would be great. And again, if you have questions about your portfolio, if you'd like to call my office for a consultation, that number's on the bottom of the screen. I'm going to put that up again, but go to my website, ReznyWealth.com. Make sure this Sunday, by the way, we will have a live radio show from 10 a.m. to noon, as we do every Sunday throughout Florida. Go to my website, ReznyWealth.com, to check out the times and availability. Under our investment management, this is our commitment to you folks. Under our investment management and financial guidance, you will sleep well, you will enjoy life, and more importantly, you will have less stress over your investments. Call us for a consultation. There is a difference. We invite you to experience it. Have a great evening.